Selling your software to all of Europe takes one payment integration and about 10 minutes. Charging the right tax across all of Europe, that's the part nobody's launch tweet mentions. So let's fix that today, before 27 tax offices fix it for you. First, a disclaimer. This video is for informational purposes only and does not constitute legal advice. Consult our team or another qualified professional for personalized guidance. Hey everyone, Robert here, legal consultant, licensed tax advisor, and registered trademark and design representative. And today we are on my home turf, tax. At Chiroptera Consulting, we help software founders sell across borders without lighting money on fire. And there is no place founders light more money on fire than EU VAT. VAT. Here's the good news up front. The system is actually friendlier than its reputation. One registration can cover the whole EU, but only if you dodge the 5 mistakes everyone makes. Let's count them down. Mistake number 1. And it's the big one. Founders charge their home VAT rate to every customer in Europe. Feels logical. It's wrong. For digital services sold to consumers, the rule since 2015 is the destination principle. The customer's country sets the rate, not yours. And digital service is broader than you think. Anything delivered over the internet, essentially automated with little or no human involvement. SaaS subscriptions, app purchases, downloads, streaming, ebooks, hosting, pre-recorded courses. Since last year, even tickets to live stream events sold to consumers follow the customer's country. What's not on the list? A human consulting over a video call. That's a human service with different rules. And boxes with shipping labels, goods play by their own rulebook entirely. Today's scope is purely digital. Now, feel the stink. Rates run from 17% in Luxembourg to 27% in Hungary. So if you're a Slovenian company charging our 22% to a customer in Budapest, Hungary still wants its 27, and clawing your 22 back from Ljubljana is your paperwork problem. One flat price across Europe also means your margin quietly changes with every border. Most founders have never even looked at that. Mistake 2. Assuming small means exempt. There is a lifeline and it's real. If your business is established in just one EU country and your cross-border sales to consumers in other EU countries stayed under 10,000 euros this year and last year, you may keep charging home VAT like nothing happened. Lovely, right? Now the trap. 10,000 is EU-wide, all other countries combined, not per country. It counts your digital services and goods you ship to consumers across borders together. One good launch month can blow through it. And the moment you cross the line, the switch is instant. The very sale that crosses it is already taxed in the customer's country. Oh, and if your company sits outside the EU, forget the lifeline entirely. For non-EU sellers, there is no threshold. Euro number 1 is already taxable. Mistake 3 is the panic response to mistake 1. I can't register in 27 countries, so I will just not comply. You don't have to register in all 27 countries. Introducing the one-stop shop, the OSS system. You register once at home, each quarter you file one return listing, what you sold to consumers in each country and at which rate. You make one payment due a month after the quarter ends, and your own tax authority forwards everyone's share. That's the whole trick. Charge 27 rates, deal with one office. What about if you are not established in the EU? There's a twin scheme built for you. And remember, you never had the 10,000 euro cushion. 2 housekeeping rules. Make it stick. First, you have to know where each customer actually is and be able to prove it. Normally, 2 matching pieces of evidence like billing address, IP address, or the country of their bank. If these cross-border sales stay under 100,000 a year, one piece is enough. Second, keep those records for 10 years. Skip all of this and the math is brutal. You owe every country VAT you never collected, out of your own pocket, plus interest and penalties. And serial offenders get kicked out of OSS, which is when it really does become 27 registrations. Mistake 4 lives on the B2B side. Founders hear business customers handle their own VAT and relax. The rule is real. Sell to a business in another EU country and you charge zero, the customer self-accounts under what's called the reverse charge. Your invoice literally says reverse charge and you report the sale in a short list to your own tax office. Beautiful system, but it runs on one thing, a valid EU VAT number. You check it in VIES, the EU's free verification tool, and you keep proof of the check. No number or a number that doesn't validate, then the law's answer is simple. Treat them as a consumer and charge their country's VAT. Even if they insist they're a business, even if the mail signature says CEO, a company logo is not a VAT number. And two quick edges. Business customers in your own country get normal domestic VAT. And business customers outside the EU are generally outside this system altogether. Mistake 5. The modern classic. My payment stack handles the tax. Sometimes that is true, but usually it is not how you think. There are 3 kinds of middlemen, and founders keep mixing them up. A payment processor thinks Stripe, moves the money, and can even calculate the tax for you. Calculate. The liability stays 100% yours. An app store or marketplace, think Apple or Google, is different. There the law flips the table and treats the platform as the seller to the consumer. So the platform handles the consumer VAT and your sales is a business sale to the platform. Don't pay that VAT twice out of guilt. And a merchant of a record, the pedal-style setup, actually buys your product and resells it. So consumer VAT is contractually their problem and you invoice them B2B. 3 doors, 3 completely different answers, so read your contracts and know which door you're standing in. And if the secret plan was to quietly ignore the whole video, since 2024 payment providers report cross-border payments into a central EU database built precisely to spot sellers like that. The tax office doesn't need to find you. Your payment data already made the introduction. Fire recap. Consumers pay their country's VAT, not yours, and the rates run 70 to 27%. Under 10,000 euros of cross-border sales, EU-wide and counting goods too, you may stay on home VAT, but the switch is instant and non-EU sellers get no cushion at all. You don't need 27 registrations, you need OSS. 1 return, 1 payment, plus evidence of where your customers are and 10 years of records. Business customers mean reverse charge, but only with a VIES validated VAT number. No number, they're a consumer. And know your middleman. Processors calculate, app stores and merchants of record actually take over. And since 2024, your cross-border payments are reported either way. Not sure if you've already crossed the threshold, need a OSS registration, your first return filed, your invoices and evidence squared away, or your past cleaned up because you got a little too creative? This is exactly what we do. Book a free call with us, link is in the description below. And if this video helped you, send it to your connections, smash that like button and subscribe for more straight talk tax and tech compliance. Thanks for watching and remember, compliance with the law prevents the flaw. Till next time.